Good morning, traders. Today is Tuesday, January 28th, 2014. My name is Christopher Vecchio, currency analyst with Daily FX. If I could just get confirmation that we have audio and video up and running, we will get started right away, as we have about 8.5 minutes now to this release. All right, I do see that audio and video is now up and running, all okay. So, of course, there are two things that we need to look at here: what the expectations are fundamentally, so we can set our psychological benchmark, and then we can take a look at where the technicals are. But in terms of what we're looking at here for the UK GDP figure, this is going to be one of the best reports we've seen in several years. Now, in terms of where the UK currently stands, we see that going into the end of the year that there was a significant improvement in the PMI data. There was significant improvement in the retail sales spending data, actually a huge beat in the December retail sales figure. So there are expectations going into this print. Overall, I'm just pulling up the charts here to make sure I have the correct fundamental information coming at you. All right. What we're seeing here is that the expectation for today's GDP print is rather strong at plus, let me just finally get plus 0.7% quarter over quarter from 0.8, plus 2.8% overall from 1.9%. So this would be the strongest overall period of growth that we've seen since this 2007 period, 2008 on the quarterly basis. And this would lead you to believe that maybe the UK economy is continuing to get stronger and stronger and stronger, despite the fact that the British pound's been elevated. Certainly the pound's been so strong that inflation's been coming in check, which is a welcome development for our UK listeners. But overall, I think that this pair or this index looks like this is just wanting to continue to climb higher. All right, it looks very bullish to me. I don't see any reason why this should stop. I know we have the Fed tomorrow. I know we have UK GDP today. But for now, trying to short this market without really a good technical reason to do so has been a fool's game the last several months. And so that's worth stressing here, because there's no reason to just be a hero. Now, that being said, all right, I look at pound dollar and I can't help but think that this is starting to look more and more and more like a little bit of a rising wedge, right? And that to me would be pretty bearish overall. The implications would be pretty bearish overall. But for now, we're looking at a move above 166.75 is nullifying that. So this is something to keep an eye on, I think, over the next few days and weeks, see how this plays out. And I think this is what we should be operating in context of. You know, something I want to point out here, okay? Just because we see a meet or beat or even a miss on expectations doesn't necessarily guarantee which way price is going. For example, if just because we're at 0.7% expected from 0.8 on the quarterly, if we get 0.8, that doesn't guarantee that we're going to rally. It's probably going to take 0.9 or 1.0. All right. That being said, this pair, this currency, the British pound, is a lot more susceptible to negative surprises than positive surprises because of A, overextended positioning, B, renewed hatred for the US dollar, but C, I think more importantly, you know, at this point in time with forward guidance changing, if we have a miss here on GDP, this could really ramp up those dovish policy expectations. And ultimately, if there are dovish policy expectations are ramping up, then we're going to maybe see a bit of a pullback in the pound. And in that case, we're going to be more open to this price action that could be developing more bearish. You know, pound yen, to me, it's starting, you know, I think that it's appropriate to hold a bearish bias relative to last week's highs. And I think I'm going to start scaling out of my position at this point in time. But, you know, we say that and we talk about these potential uptrends in these various yen crosses breaking. And we're going all the way back to November 2012 to establish the lows for these yen crosses. We see here that there's a lot of pressure. A lot of pressure in several of these crosses recently where we came into big levels. Excuse me. where it looked like we were due for a bigger pullback. And so now that we're already seeing the yen reverse, very much like we had at the beginning of last week, where we had one big down day, almost immediately followed by a reversal. Like we saw that Friday was the pause, Monday got us lifted off, Tuesday's following continuation now. Pound yen looked like it was getting ready to have a bigger breakdown, but technicals haven't just really given way. We're seeing breaches of lows, but really nothing now. Stochastics are turning higher. So if we get a breach of the 173.75 area in pound yen, then we're talking about a situation in which pound yen is now cleared a former swing high, broken the weekly high. We now no longer have a series of intra-month higher highs or lower highs and lower lows. That downtrend may be shifting relative to that high. And again, the high for the year was set on the first day of trading. So, to say that the range was broken, the opening weekly or monthly opening range was broken, it's not a hard argument to make. Generally speaking, I see this as a good question here, more about methodology or for perspective. What do you use when you're considering the opening range for the week? So when I'm trading, I usually use on a scalping basis. And when I say scalping basis, when I'm looking at charts, shorter term charts under an hour, I look at the first half an hour of trading, especially when it's the 9:30 to 10 o'clock hour in New York. Even if I'm looking at euro dollar daily chart, I'm going to take an eye on, take a look at what's going on in that final in that hour 30-minute chart, because it's going to give me a perspective that I can't get on the daily. I'm going to get that near term, whether or not I should be adding, or whether or not this is a bounce or just contrarian move, or I think that when you look at that 30-minute range, like, okay, it's moving against my favor at the beginning of the market, whether or not you should take a position or add. And it's a good gauge. So, I use that for if I'm taking day positions. I look at, say, an hour if I'm talking about the whole day, the 24-hour period overall, okay, and I go that based on there, and then finally a day. So here we have the print coming out in just a few seconds. Again, 0.7 from 0.8 expected. And here we go. We see that the pound yen is starting to oscillate rather quickly here, and that makes sense. So we see GDP 0.7 as expected, so a slight miss. And we talk about a potential a miss there, and we see the pound yen pulls off, but the 2.8 is on the head, okay? Exactly on the head. So not really much of a surprise in either direction. Okay, just a slightly weaker on that quarterly figure, but really nothing major, okay? And I stress that because it's important to note that there was no big surprise to the upside. So we got a drop from 165.90 all the way down to 165.48. We're back at 165.77. As I said, we're seeing the pound come off just a little bit here, but nothing major, okay? So we're down 15 pips on this 1/10 of a point miss. Now we have an inverted hammer forming on the daily chart. Okay, so I think that's important to keep in mind. All right, is this a reason to get all bearish now? Perhaps it stokes the short covering or in the dollar relative to the pound, right? Everyone's short the dollar, long the pound. Maybe we see that. Maybe we see those longs actually take profit. Okay, this could be a catalyst. I know it's near what we were expecting. However, psychologically, if you're a trader and you've been riding this pound dollar uptrend for several months and you think this is as good as it gets for the UK, and that anything going forward is going to be more bearish and growth is really topped out, then why would you want to be further bullish on the pound? All right, so this could be a profit-taking opportunity. I mean, always envision the other side of the trade. That's important. Why would you want to be bearish here? Well, if you think the Fed's going to taper irrespective of what the incoming data has been, and you think that's going to lead to higher U.S. yields than it has been in the past, we saw after December 18th that U.S. yields ticked higher. That would be a fundamental reason to look short against the high. We have this little slightly weaker than expected GDP report. The Fed's going to come out, I believe, and be a little bit more hawkish than people expect, because they're not going to let one GDP report deter them. But I look at this and I see the pound dollar here on the daily chart. part of this last part of this uptrend looks like it's starting to break, and that'd be really critical because, it would show that even the indicator, and indicators have patterns, and I firmly believe this. Okay, it'd show that the indicator is topping out too. And you can see here how it's actually the more precise to make this, the better it fits what I'm trying to go for. All right, we can see how the indicator channeled in the month of January. All right, and that's really contained price, and we've actually see that we are trading in a range. So the indicator ranges and price ranges. All right, the thing is, the indicator is breaking down through this support. Okay, so theoretically, if we see indicator lose support here, then we might be seeing the trend be lost. So I'd be looking towards that 30 figure, right? And it's very clean how just right above 30 this based. All right. If we get a real concern and move below 30 in the indicator, that would probably be a confirmation that we've also broken the last swing lows coming in near 163.15. Let me just change this up so it's more visible. All right. So I would be looking, if the short's going to ever gather pace, it's got to be below 163.30, right? On the flip side, I might do point out here that the daily, now after reclimbing above 166, is at 54. All right, so percent K is back over percent D on the daily chart here. So maybe this is not going to deter people at all. All right, so that's going to be important to watch out. I'm looking at some statistics by the ONS. So we're seeing that of the 7, all right, so up 0.7% of that quarterly growth, 0.61 of the 0.7 came from the services sector. 0.1 of the 0.7 came from construction, 0 came from agriculture, and negative 0.02 came from construction. So construction actually took away from GDP this past quarter, and that that's not quite adding up, but I guess that's the math that they chose to do. So, right? 0.61 plus 0.1 is 0.71 minus 0.02 is 0.69. So, they're giving a little bit of a generous point. They're giving a generous bump there. But I suppose if they want to round up, that's their prerogative. But we're seeing here overall that services sector, we're talking about retail sales, PMI services. These guys are so strong. If those are going to be the forebearers of UK growth, then the UK still looks like it's on good footing. And I quite frankly wouldn't be too concerned about buying pullbacks in the pound going forward. Overall, I think pound Aussie remains the most provocative play for me long term, given the emerging market turmoil, given the fact that we have a very, very tempting pullback the last 2 days that really offers us a discount. And I say pullback the last 2 days because yesterday was certainly boring. But look at this. We've seen a real significant pullback in the indicator. Okay, and the last time we were at the indicator was here. We were trading at the 8 EMA. And we're trading at the 8 EMA today. We look at the 1 minute chart. It's like an EKG right here. Pulse down at the 430 print, and then now we're 70 pips higher. So talking about how crazy price action can be. So pound Aussie looks like maybe that might have been the low. So we'll keep an eye on that. We do see that this was a tentative range break. And this goes alongside with our friend Aussie dollar. I'm actually behaving pretty close to perfect, in my opinion. Let's just get this up here. All right. This was the focus of the video yesterday. Okay. Let's take a drawing off the highs we recently had. So yesterday I was saying that it looked like we could have had a short-term basing event going on in the Aussie dollar. Short-term reversal might be declared underway if we were to able to climb through 88.10, and that would be because of this potential bullish falling wedge. But it really wouldn't be too much concern. Now, why is that? Well, there are a number of things going on long term here as well. That unless we cleared 88.10 on a daily basis, there's reason to have confidence that this was still a bearish market. So just to give some perspective here on Aussie dollar, why pound Aussie is potentially acting the way it is. All right, and this is a good way to break down components. If you're ever looking at a currency and you're saying, I can't for the life of me figure out where this guy's going, then step back and look at the components. I mean, if measure them against different things. If you're looking at pound Aussie, look at the pound and look at the pound dollar and look at Aussie dollar. Okay, if you're looking at pound dollar, look at pound yen and dollar yen and see where each thing stands. And if you're bullish on the pound and bearish on the Aussie, and you're bullish on the pound dollar, right? Ultimately you're going to have to decide if you're more bullish on the Aussie or more bullish than the dollar. Pound Aussie or pound dollar, one will be ahead of the other, and therefore Aussie dollar will move. So you can determine which will be the better pair to, exemplify your opinion. If you're bearish on the Aussie, why not play it against the most bullish currency? So determine what the most bullish currency is. Don't just, play it against one. That's why actually I've been finding recently, whenever I diversify, right, if I think I'm going to be bearish on the Aussie and I don't just sell it against the euro, I sell it against the euro, pound, yen, and dollar, and I split up my leverage and I go a little bit smaller, I found that I've been trading better. Just anecdotal, and I don't have any statistics to back that claim up, but I've been much more comfortable recently. I've been able to sleep better, and I think that, that we talk about the sleep test, tongue in cheek, but legitimately, if you can't, it's called the sleeping point. Jesse Livermore came up with it. Who better to take trading advice from than just one of the all-time greats? And he says that, trade down to a sleeping point. Okay, get to the point where you're not anxious, that you're not losing sleep over your trades, and at that point, that's when you have the right amount of risk on. And certainly by diversifying, it doesn't matter if euro has a tail event for the day, so to speak, a miss on a report that was unexpected, and it causes euro Aussie to plummet, because if Aussie's still losing ground against, say, the pound, yen, and dollar, I can still push forward my idea. But so what we're saying is here, Aussie dollar seems like it may be working on this reversal right now. I mean, you can see it here now on the red chart, right? Now that it's outlined as such, it looks a little more clear. This would only give way for a rebound, however, back towards 89. And at that point, we're only talking about 100 pips. And I really don't think that brings too much to the table to be concerned about for the bigger picture. In that case, we just may be working out like a longer term or a bigger channel here. Okay, that's always possible as well. So there are a number of things that could happen where we could see, if we see failure again ahead of 89, that could be a signal. This could be a sign here. Technically, we're just in another selling zone, right? 88.20 was really the top side of that zone. Now we're back here at 88.02, and if we see failure here, we've already had a bit of a kick up, and this wouldn't be, too surprising. This would actually be the hallmark of a bear market. We see the potential for a bullish rebound, and we can't even clear the last swing high. Okay, that would be pretty indicative of a potential top, in my opinion, that this is, more or less. Look how systematic this is. It looks like there's no one in the market right now. This is just getting chopped higher, right? Up, tick back to the 21, up, tick back to the 21, up, tick back to the 21, up. Now it's a little more bullish, 8 EMA. All right, so now we're going to see what happens as we get down to 87, 85, but I wouldn't look, I wouldn't discount that entirely. And if you look at each of these rallies, it's pretty much returned to the base before moving back up. It's been very square. So the fact that we have an inverted hammer against the zone of resistance that we're talking about near 88.10, I think that means that we should be looking lower here. Potentially pound Aussie then has a long opportunity against the low. All right. All right, we do see we have this very nice hammer to work with. You know, that we look at stochastics here and we look at the hourly, and actually I prefer to look at 2 hours when using stochastics. Okay. All right, these are all good things that are happening because this is where you make your metal in the market. All right. So this is the uptrend that pound Aussie's been riding the last several weeks, and this is since it nullified this potential head and shoulders breakdown. Okay, so this is the indicator pattern since we had this breakout, right? So this is important to consider because this is the nature at which the advances have taken place. Okay, and since this low, these buy signals in the stochastics on this 2 hour period have been rather accurate in calling the turn higher. Let me just change these up so these are a little more visible because this will be my last point I'm going to make because we do have a trading Q&A at 6 Eastern, 11 GMT and Daily FX Plus. So there's no reason to get too detailed here. I don't want to share all the secrets to the sauce, cannibalizing my potential interest later. Let's see here. So 1, let's add these on. 2, no, that's not meeting the condition of coming out of oversold territory. This one is. This one is. All right, and now we have here. All right, so I'm going to delete today's, but now we have another cross coming, right? We see that 25 is above 20. We're coming out of oversold. All right, so what does this mean? These are the other 5 instances in the uptrend since the low on the 13th that pound Aussie has responded to a turn higher out of the oversold reading in the indicator. Slow stochastics on a 533 basis. Today would be the 6th occurrence. Okay, we see that each of these has actually occurred at a higher low. This is a pretty terrible color for this one back here. And I can't even show it behind, so I'm just going to delete this one here. But we see that, but for today, each of these occurred at a higher low. So that's the first note, okay? This signal is already weakened by the fact that the pattern has changed. We had a bullish signal in the stochastics at an increasing rate of price on each of the past occurrences. This one will be the first one that's different. So we already see that the uptrend is not as strong, all right? We see a downtrend, though, in the indicator. And we see price responding with a hammer at above former resistance. So this is a low risk, in my opinion, a low risk long, right? Because we see that if we do break this reaction low, and I know that's about 100 pips you're going to have to give into these former highs, but if you do see that we break this reaction low, then you know that maybe the trend is changing. Okay, if we do see that the signal that we're getting now doesn't behave like these prior signals that we've just had in this trend, in this uptrend, we get a break of this low. We've had a cross. Okay, look at the indicator. We've had a cross. So now if we get a move lower in the indicator again, and this cross fails, that would be a sign that we're about to have a failure in price as well. So pound Aussie looks like it wants to rally here. I would keep an eye on this very closely as, again, 1, 2, 3, 4, and 5. You know, this 5th one didn't produce much of a bounce, more sideways, and that already shows how much the trend had weakened at that point, right? Unlike the other ones, strong, 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 strong. But now we're already into support. Trends take like 2 or 3 touches of a support line to produce it. Ultimately we're going to need to see this clear over the coming hours. But pound dollar looks like it's perking up. Aussie dollar looks like it's giving back. Right, 897.95. And just want to head over to pound dollar here. Where are you? Right above US dollar, of course. It's 165.86. Okay, so already seeing a reversal. I can't emphasize how much that you should wait to trade in price. I know people want to be the hero and get long or get short, and I told you we can't wait to get. I don't like trading in price, right? And I'm expressing my almost cynical laugh here because I said before I wouldn't even want to look short below 163.60, and I saw, how come I saw so many prints. How come it's a bad print? But look at this. Already we are trading literally 40 pips higher from where, or excuse me, 35 pips higher from where we first took a glance at pound dollar. And so, the big picture here is this is such a big event risk, right? UK GDP. We have such big event risk tomorrow, Fed, FOMC, that the chance of being just knocked out of the position on volatility alone is increased. You might as well wait till you get a clear sign that there's direction. This is such a strong uptrend that if you're trying to play the big breakdown in pound dollar, all right, I know this 200, 250 pips from here, but I think this is zoomed in. All right, if this is, so far away from here, you really have to consider that this kind of pullback would be a much bigger move than 200 pips. It could be 800 pips, 500 pips. A falling wedge or rising wedge, the nature of them dictates that you see a return to at least the first swing point, and then ultimately you would be looking to the low. So we'd be looking for a return towards 158.60 at a minimum. For me, waiting to get a 200 pip confirmation, a free 200 pip confirmation, at the top of price, the highest where price has been over the last several years. Look at where you'd be shorting the market at the highs, right? At its highest point since 2011, August 2011. I think, right now it's worth just waiting. There's patience, you'll never get hurt, you'll never lose money by being on the sideline. And there's always opportunity out there. And that's one of the things that new traders really need to understand, that just because you're not in the market doesn't mean that you're not managing your risks properly. Okay, sometimes it's better to not be in the market at all. And quite frankly, there are times when I think all of us wish that we didn't take a trade. And so, be aware of those times. Be aware of when you're good to go. And when you should be trading, when you should not be. So, just right now, it's wait. We could be triangling here, right? It could even be more near term than this potential bigger breakdown. And we'll find out shortly. These are short-term patterns. These aren't weekly or monthly patterns. These aren't fundamental ideas that are talking about, participation rates or anything. We're talking about things that will be resolved over the next 1 or 2 days. So just sit tight and establish a plan. Tell yourself if price gets above, gets above this zone. Make up rules for yourself. And I really, we're trying to teach this to one of these techniques to our interns, of course. And I love seeing on their charts when I walk by and say okay, no matter what I'm thinking or feeling, if price comes up into, here for example, I'm buying, and let me just. They're saying no matter what happens, if I see price in this area, I'm going to buy. And you like to hear it because it means they're not making decisions based on if price falls up here, then I'm going to sell. Why would you sell for breaking the series of lower highs, right? That doesn't make sense. You'd want to be buying that. Same thing. If you want to be buying, on a break below the most recent low, maybe you buy in this area, right, with the stop somewhere down here, but you wouldn't want to be buying unless you broke the uptrend. So set yourself a game plan. Tell yourself that here's what I'm going to do when it happens. That way, when it does happen, You don't have to rethink. You don't say, oh, I'm out of the money. What do I do? I have to add to my losing position. No, because I told myself that if I was long here and we got to move under 164.50, I would be out of the market completely. And it's in the zone. I should be getting out. Out. Even if it rebounds, that was your risk. Set yourself rules. Unfortunately, I do see that I'm running way over time for this. And there was a lot to talk about, and there were a lot of trade setups to go over. And I really wanted to take the time to go over some of this trading philosophy. But if you didn't have your question answered, don't worry. I apologize. Don't feel frustrated. I'm going to be back in an hour. And it's purely intended for your Q&A. It's not about any specific currency or event. So if you do have questions on Euro Yen, Aussie Swiss, Pound CAD, Kiwi, dollar, come by with them. I'm more than happy to answer them. In fact, I would suggest that I'm going to go through and I'm going to take a bunch of the currencies that I didn't look at intentionally, that weren't related to the pound really, or that I just didn't have time to cover or didn't have the charts ready to cover. I'm going to prepare those for you. So feel free to come back, and I'm going to take a look at those especially. I do see that there are several people looking for further charts here, but again, you have a lot of questions here, and I can't cover them all in the limited scope of time. I do appreciate everyone coming out here. The indicator that I was using in this particular webinar was the slow stochastic on a 5-3-3 scale on a 2-hour chart, 4 points of illustration only. And again, anything that you're seeing here, any trades that you see that I'm in, of course, past performance is not indicative of future results. As that being said, keep an eye on the docket today. Trading Q&A coming up at 6 Eastern, 11 GMT. I highly encourage you to come out to that. I would love for you guys for us to continue the conversation there and go over trade setups into FOMC. If you're not going to come for that, do keep an eye on the calendar. Consumer confidence and durable goods out of the United States today for the months of, I believe, December and January. So expect volatility. And after that passes, expect a snoozer, right? It is going to be the pre-FOMC snoozer where everything tightens up. There is some talk about some emerging market activity. So keep an eye on that as well in the central bank space. I'm not allowed to go into it further, but I would keep an eye on that given what the various crises have been. So news headlines, they've been well signaled. I would just take a look and see if there's any, say, emergency currency interventions going on in the EM space, how that might direct regional safe haven flows, for example, in the euro dollar or pound dollar, if there are, say, dollars being sold to balance out a currency elsewhere. Look for that effect. That might have an impact, okay? There's no guarantee, but in my opinion, if we do see a major central bank in the market, or a secondary central bank in the market, there are going to be traders who are going to try and take advantage of the situation. So keep that in mind. And I can't go into much more detail there, but I do want to encourage you that you should always be aware of risk. So just because I say that, it should be a snoozer, there are a lot of other concerns going on around the world. China credit concerns, Chinese growth concerns, emerging market financing concerns, Eurozone deflation, UK forward guidance. Canada is seeing its own slowdown, and whether or not the RBA is going to ease further in Australia and this economy is going to finally pick back up. Everywhere, Latin America, the Argentinian crisis, Brazil has had its problems recently. The Russian ruble is having its problems now ahead of the Sochi Olympics. So there are things everywhere. These problems aren't just going to go away just because one thing has happened. All right, so keep an eye on the headlines. They will be important more than ever, I think, in 2014, the next few days. I know that's only a very limited sample size to be referencing, but I do think that the next few days, because of FOMC, because of what's going on, we'll be keeping an eye on the calendar more so than usual. Again, I'll be back at 6 Eastern, 11 GMT. I'm going to put the link for the Daily FX Plus in Cover It Live. Listen, if you're not a Daily FX Plus member, you're not a live account holder from FXCM, then shoot me an email if you want to come out for it. Just I can shoot you a trial login over, and if you want to get your question answered, just come on over. It'd be great if you could see what else we have to offer back there with our SSI services and technical analyzer and educational content. And so, if you are an FXCM account holder and you've never been in DailyFX Plus, just go to dailyfx.com. I'm going to put over the link, but go to dailyfx.com and go over to the Plus section, and it's very easy. You'll be able to quite easily. Let's see here. Yeah, sure. dailyfx.com. Let's just do this. Plus, and just put in your username and password. Username, your account login. So for me, I would put in, I'd start putting in my account information here, and right, and now you know my account number, and then I would go into my password. So that's all it is. And I'd go into DailyFX Plus, and that'd be that. But you can get everything back there, and that's where the webinar will be. And I suggest really coming out for it. So if you want more information, I'm going to put my email, contact information. You can reach out to me and cover it live. I really do appreciate everyone coming out today. I'll be back later on this week to cover the German employment reading. That's, I believe, due out tomorrow. So feel free to come back for that. And again, if not, good luck trading. I hope you all have a good day. Of course, keep an eye on those calendars. Don't forget to manage your risk.